Hello everyone. My name is Rahelia Parwati, and my ID number is 234111051, and I'm in class MNJ23C. Today, I'll be discussing the topic of bank health. This video is part of my coursework, and I'm excited to share what I've learned with you. Let's dive in. 1. Understanding bank health. Bank health is a description of a bank's ability to maintain its stability and sustainability through adequate liquidity, healthy profitability, good asset quality, and effective risk management. To assess the health of a bank, a number of indicators such as capital adequacy ratio, CAR, non-performing loans, NPL, return on assets, ROA, and loan-to-deposit ratio, LDR, are used. Evaluation methods such as Camel's analysis and stress testing help in assessing the performance and resilience of banks. Strong risk management practices, portfolio diversification, monitoring of non-performing loans, and good liquidity management are key to maintaining bank health. With the advancement of technology, banks can improve the efficiency and security of their operations, while strict regulation and transparency help maintain customer trust and stability of the banking system. For example, the 2008 global financial crisis demonstrated the importance of good risk management in maintaining bank health, with banks with sufficient liquidity and high asset quality able to withstand the crisis. 2. Bank health indicators. Some important indicators used to measure bank health are: the first is capital adequacy ratio, CAR, the capital adequacy ratio that shows the bank's ability to absorb losses. A bank with a high CAR means it has enough cushion to withstand losses that are not unexpected. Second, non-performing loans, NPL, the percentage of non-performing loans that indicates the quality of bank assets. The lower the NPL, the better the quality of loans owned by the bank. Next, return on assets, ROA, a measurement of profitability that shows the effectiveness of the bank in generate profits from owned assets. High ROA indicates that the bank is efficient in managing its assets. Lastly, loan-to-deposit ratio, LDR, the ratio of loans to deposits that shows the bank's liquidity. A healthy ratio is usually in the range of 80 to 90%. 3. Measurement methods. There are several methods used to measure bank health, including Camel's analysis, an evaluation method that includes capital adequacy, asset quality, management quality, earnings, liquidity, and sensitivity to market risk. This analysis is used by banking regulators to evaluate the overall performance and health of a bank. Stress testing, a method used to evaluate how well a bank can survive in a bad economic situation. Stress testing is often done to prepare banks for an economic crisis. 4. Risk management practices. Good risk management is essential to maintaining the health of a bank. Practices that can be implemented include diversification of loan portfolio, reducing risk by not placing all loans in one sector. For example, if a bank provides most of its loans in the property sector, the risk will increase if the sector is experiencing problems. Strict monitoring of NPLs, improving monitoring and collection of problem loans. Banks must have an effective system to detect and handle problem loans early. Good liquidity management, maintaining a balance between short-term assets and liabilities. Banks need to ensure that they have sufficient liquidity to meet the needs of customer withdrawals. 5. Regulation and policy. Strict banking regulations are needed to maintain the health of the bank. Some important regulations include minimum capital requirements. Banks are required to have sufficient minimum capital to withstand possible losses. Supervision by financial authorities. Authorities such as Bank Indonesia have an important role in overseeing bank performance and health, including through periodic inspections and audits. 7. Steps to improve bank health. There are several steps that can be taken to improve bank health, including capital enhancement. Banks need to ensure that they have sufficient capital to withstand possible losses. Risk management enhancement. Banks must have an effective risk management system to identify, measure and manage risks. Strict internal controls. Banks must have a strong internal control system to detect and prevent problems before they occur. Portfolio diversification. banks need to diversify their loan and investment portfolios to reduce risk. 8. Challenges and risks. Banks also face various challenges and risks that can affect its health, including credit risk. The ability of debtors to repay their loans greatly affects the health of the bank. Economic crises can increase credit risk. Liquidity risk. The ability of a bank to meet its short-term obligations is very important. Liquidity imbalances can cause major problems. Market risk. Fluctuations in financial markets can affect the value of a bank's assets and liabilities. Operational risk. Human error, system failures, and natural disasters can affect a bank's operations. 9. The importance of transparency. Transparency is key to maintaining the trust of customers and other stakeholders. Banks must ensure that they provide accurate and timely information about their performance and financial condition. 10. Case example. For example, in 2008, the world faced a global financial crisis that caused many large banks to suffer huge losses and some even went bankrupt. The banks that managed to survive were those with good risk management, sufficient liquidity, and high asset quality. 11. Conclusion. Maintaining bank health is a complex task and requires a comprehensive approach. Banks must be able to manage risks, improve efficiency, and maintain transparency to ensure long-term stability and growth. With the right steps, banks can remain healthy and serve as important pillars in the economy. Maybe that's all I can say. Hopefully this material is useful. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.